Hello class, this is Dr. Fenton, and in this video I would like to show you how individual transactions impact the financial statements. We are first going to concentrate on the income statement and the balance sheet, and later we'll take a look at the statement of changes in stockholders' equity. Let's get started. So let me remove our video. Now you can see the spreadsheet I prepared, and this is in the typical accounting equation format that you can see across the top. The assets will equal liabilities plus stockholders' equity. We're going to enter individual transactions that will come from the second tab down at the bottom. Click on it, and you can see 12 transactions that you should be familiar with. The first one, let's go ahead and take a look at, enter it. The organizers of the new corporation contributed $100,000 in exchange for stock of the corporation. To enter this in the spreadsheet, cash is increasing by $100,000. Then we have to enter the reason the cash came into the business. That will be over here in the common stock account. So $100,000 here. You'll notice after this transaction, the income statement was not changed. Neither one of these are income statement accounts. Look at the balance sheet, and we show a nice simple balance sheet. The only asset we have is cash, and the only thing on the right side of the balance sheet is the common stock account, $100,000. And of course the two sides balance. Let's look at the next transaction. The corporation paid $60,000 cash for inventory. So we need something to sell to the customers. We're going to use $60,000 cash. So we're going to enter a negative 60 in the cash account, then record the reason that we paid the cash out, and of course inventory is increasing. And what we've done is exchange one asset for another one. Again, the income statement was not affected, but look at the balance sheet. The right side of the balance sheet did not change, but on the left side under assets you can see where we now have cash of $40,000 and inventory of $60,000. Still totals $100,000, and the balance sheet stays balanced. In the next transaction, number 3, the corporation paid $10,000 cash for advertising that will be used, in other words published, during the next 6 months. So this $10,000 amount that we're paying, and record that, of course, negative 10 in the cash account, is for prepaid advertising. So we're going to use this advertising in the future, and as soon as we buy it, it's going to be an asset. So plus $10,000 in the prepaid advertising account. We still have not used one revenue account or one expense account. We've only changed the balance sheet accounts around, and we've been lowering cash, and now we have the two other assets, inventory and then prepaid advertising. Transaction 4, the corporation paid $5,000 cash for rent of the building used for its business. This is an example of an expense. Cash is going out the door. Then we record the reason this cash went out the door. So this expense will be recorded as a negative $5,000. That's the way I have this spreadsheet set up. This is the first transaction that impacted the income statement. We have an expense we paid for. So, at this point in time, the net income or really net loss is $5,000. We're not concerned about that now because we're still in the middle of the accounting period. The balance sheet account is now impacted on both sides, since net income will impact retained earnings, and we'll see that a little bit later on how that happens. In the balance sheet account, you see now we have a retained earnings account with a negative $5,000. The common stock account did not change, but the total liabilities and equity equals $95,000, as well as total assets. In the fifth transaction, the corporation borrowed $15,000 cash from the bank and signed a 1-year note at a 5% interest rate. So we needed some more money to get into the business, so cash is going up now by $15,000. Then record the reason this cash went up. So we have $15,000 as a liability that's increasing. The income statement was not impacted, but the balance sheet now shows changes on both sides again. Cash is now $40,000, and we now have notes payable of $15,000 as a liability. Total assets, $110,000, as well as total equity and the liabilities on the right side. Transaction number 6. The corporation sold inventory for a sale price of $75,000, receiving cash, and also the inventory we sold cost $50,000. We have two parts to this transaction. Let's record the sale, $75,000, and cash is coming in the door from the sale. The sale is, of course, revenue. 75 is entered. But the inventory we sold cost $50,000. So we need to show the fact that inventory has now gone out the door with a negative 50, and we record that as cost of goods sold. So the cost of goods sold account, as you know, is the inventory that we've sold. So a negative 50 here. We now have revenue in the income statement, a large expense, cost of goods sold. We're up to a profit now of $20,000. The balance sheet changed on both sides. We're up to $135,000 in total assets, and we now have retained earnings of $20,000. It's a positive number at this point. Everything stays balanced in the balance sheet. Transaction 7. The corporation purchased more inventory for $45,000 and did not pay cash for it, but purchased on account. So we'll pay the supplier later. So $45,000 is another increase in inventory. Cash is not being used, so we will show this as a liability that we owe. So our liabilities went up $45,000. Transaction 8. The corporation sold inventory for a sale price of $48,000, selling this on account, not receiving cash at this point. And this inventory cost the corporation $36,000. So we're selling it for $48,000, and it cost us $36,000. Now, $48,000 is the increase in the accounts receivable account, and this account is the account that shows how much the customers owe us. It's revenue that's coming in, balance sheet, our income statement, and the inventory cost us $36,000. We reduce inventory $36,000 and show this as an expense called cost of goods sold, $36,000. Net income has changed because revenue and cost of goods sold has changed. Both assets on one side and the liabilities and equity on the other side have changed in recent transactions. But we're up to total assets of $192. In the 9th transaction, the corporation paid cash of $20,000 for a partial payment of the accounts payable. We owe $45,000 in accounts payable. We're paying part of this off, $20,000. So let's reduce accounts payable $20,000. That cost us some cash. So cash went out the door, $20,000. That individual transaction did not impact the income statement, but it did, of course, impact the balance sheet. Transaction 10. The corporation collected $30,000 cash on the accounts receivable from customers who previously purchased on account. Now, be careful in this one. Yes, customers are paying us $30,000. They are not buying more inventory. We're not making another sale. Therefore, we don't have more revenue, but cash is going up. Why did this cash go up? Because the customers paid us what they previously owed us. So that means they owe us less at this point. So take away $30,000 from the accounts receivable account. The income statement account was not affected, but the balance sheet, of course, was. The next transaction, the corporation to date has used $8,000 of the advertising. Now, if we've used $8,000, we need to reduce the prepaid advertising account. We'll show this as an expense. This is the part we've used up so far. In this one, we have another income statement account affected, the advertising expense. That transaction lowered net income a little bit. And then the assets were impacted because prepaid advertising was reduced. In the final transaction, the corporation paid a dividend, a cash dividend, in the amount of $4,000. Cash is going out the door, and dividends were paid, -4 here. And now we finished all the transactions. So now we have an income statement that shows revenue of $123,000, 3 expenses totaling $99,000 with net income of $24,000. The assets total $160,000 at this point, and the liabilities and equity also total $160,000. Now if you look closely, net income is $24,000. Our retained earnings is only $20,000. Earlier we saw that was the same number, but if we scroll down and look at the statement of changes in stockholders' equity, we can see that yes, net income will increase retained earnings, but when we pay dividends, dividends are a payment of part of the profits to the owners that will reduce retained earnings. So that's why ending retained earnings is only $20,000. So I hope you were able to see how individual transactions impacted the financial statements. Go back and review this video and watch carefully as each transaction is entered, which statements are impacted and how they impacted. Let me know if you have any questions, and I'll see you in the next video.